FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome, and this is the Financial Survival Network. I'm Kerry Lutz, and today is March 13th, 2018. We're getting close to the Ides of March, which can have market consequences on occasion. Well, hey, as always, join the show, join the dialogue, the conversation. Email us at kl@kerrylutz.com. So debt problems, have they gone away? The economy is booming, supposedly, but is it really? Well, here's Danielle Park, jugglingdynamite.com. Danielle, good morning.
Hey, good morning, Kerry.
So where are we now?
Oh, goodness. We are deeper and deeper and deeper into the hole. You know, we are trying to go forward by building more foundations on sinking footings. And it's rather sobering to watch, Kerry. You know, it would be much easier if one could be a perpetual optimist and not sweat the details about anything and just always hope for the best and hope for good luck or pray or whatever people do that that the unsustainable can continue. But you know, we've really painted ourselves into quite a corner here. The Bank of International Settlements is out with their recent March 11. They came out with their latest missive on where they're seeing concerns in the world. And you know, I always get a good laugh out of the Bank of International Settlements, not because they're not, you know, reputable people or anything. They're the head of the 60 largest central banks in the world. So they all go for bi-monthly meetings in Switzerland. What I find always amazing is, you know, when they're here, they never see any real problems. There's no bubbles. There's no likelihood of recession. There's no financial crisis. No one ever sees anything in their domestic economy as a central bank head. But once they get to their meetings in Switzerland every couple of months, you know, they let the guard down. And then as a collective, they're issuing warning after warning about the toxic levels of debt in many of the world's largest economies. And the latest report fixates primarily on the red alert readings in the Canadian banking system, China, and Hong Kong. Those are the 3 largest problem child, so to speak, right now in the world. And they point to, you know, the 2 of their key indicators being credit to GDP and debt service ratio being in the, as I said, red alert category. So what that portends typically is a banking crisis within the next 3 years, typically. Not all the time, but a high probability of issues in the domestic banking system when you get readings like that. And when you couple that with you know, as I've talked to you before, we now have the most overvalued real estate prices in the world in Canada relative to rents and income. So, you know, you got those 2 things together, and they are related, clearly. Obviously, people have been reaching to buy real estate and piling on the debt to do so in the low rate environment and lax lending standards. And, you know, at the same time, you have the Canadian bank heads coming out this weekend. Of course, they're doing their usual Chuck Prince impersonation saying, hey, you know, everything's good. Defaults are low. We don't see any problems. You know, our lending books are pretty blemish free, all of which may be true. But the problem is it's all counter-cyclical, right? So that is always the case when they've been through a prolonged period of credit abuse and the defaults have not yet started because unemployment is still at a cycle low. And rate hikes have just begun in terms of mortgages. They're up about 1% in Canada, which is a lot, significant.
Yeah. Oh, yeah. Well, when you say a foundation, an unstable foundation, I'd say an unstable foundation that's actually built on an earthquake fault, right? I mean, it's like that building in San Francisco, I think it's the Millennial Building, that it's basically sinking. The footings weren't deep enough, and it's in an earthquake zone, and they don't know what to do about the building because it's too big to like take down. There's all these people that own condominiums there, and they've got literally a a ground floor. They're literally on the ground floor of the next big one there. That one, you got to wonder how it's going to survive. And that's the financial system. It's on this earthquake fault, and they just keep building more and more buildings on the fault.
Yes. And the thing is, they get the figureheads in that have been complicit or have gained enormously personal wealth from the creation of the bubble in the first place. So in all these positions of policy leadership, political leadership, they keep appointing, the head honchos from the institutions that help create the bubble. So two problems there. First of all, they've been personally grotesquely enriched in the creation of the fault lines. So they have a bias towards what's wrong with this? This has been awesome. We've been able to add debt on debt on debt and keep consumption going. We're now into, the nearly in another 5 months, we're going to have the longest economic expansion, market expansion that we've ever had in history, built on the weakest foundations ever in history. So the optimists and certainly the financial sector would say, hey, what are you complaining about? Look we've extended this cycle so long. The pragmatists have to look at the foundations and say, yeah, but you didn't put in the rebar, you haven't put in the correct footings, the correct cement. This is all cracked. It's all, sort of covered over. I mean, when Cohn left the White House as the economic advisor there, from head Goldman Sachs dude leaves, on the one hand, I said that's good because he was one of the architects of the disaster that we've seen in the last decade, from the financial crisis to now. But who will get replaced in these policy positions always has to be the long always cheerleaders. And, I saw this headline today saying the market's is rallying this morning on news that, Larry Kudlow may get the nod. So anyone that's been in this business or the world for the last 20 years knows that Larry Kudlow is a perpetual bull who has been a cheerleader for stocks without pause. Right at the peak of 2000, when he was on, Kudlow and Kramer, with Jim Kramer, who went on to have his own show, and then at the peak of the 2007 crisis, when he was adamant there was no recession coming, no slowdown coming, no problem. So it's fine from a personality perspective, from a TV personality perspective, perhaps, to have these, constantly optimistic outlooks. But from a risk management perspective, it's a total disaster. And this is where we are. This is why the Bank of International Settlements did that lovely little video I put on the blog about household debt and financial stability. It's not true that you can have very high household debt and consumption on credit and also have financial stability. The two are, the one is eroding the other. And this time we've eroded it the most of any other period. So we have to be concerned. Pragmatists have to be concerned. And yet, the longer this goes on, the more aggressive the permabulls, the more aggressive the add debt and stir crowd, who will say, what's your problem? Why don't you just enjoy the ride? It's so good. It's so good.
Yeah. Well, the more false confidence gets exuded because they don't want to say, hey, this could be a disaster. Prepare accordingly, whether it's stocking up on food or, getting a portion of your profits out of the market poised for the eventual crash to avoid the maximum damage to your portfolio. And the worst thing is, Danielle, that the longer it goes on, the more resistant the world becomes to any common sense approach, any risk management of any kind. And the longer it goes on, is having this discussion, it's stock brokers or customers men, as they used to call them in the good old days, before the big Great Depression. They're like realtors. It's always a good time to buy real estate. It's always a great time to buy stocks. And then one day it isn't. And then they say, well, we told you, when they really didn't.
Yeah, well, and, we've talked before about the importance of fiduciary duty in advisory positions and professional advisory positions, because you literally can, enable or help people make intelligent decisions that will shore them up with greater strength and stability for the future, or you can do the opposite in those positions. And most people don't have financial acumen or, knowing what to do in terms of managing money or their expenditures and their, where to put savings and that sort of thing. So they are dependent on, quote, other people, either wise people in one's family, although they are also hard to find, or, otherwise professionals or people who advise as a living. The problem is that most of the advisors, even the ones with accreditation like I have, like the CFP or the Chartered Financial Analyst, they tend to work for the product sales organizations. And so the bias inherent is that it's always a good time to be buying risk products. That's just part and parcel. And even the ones that aren't collecting commissions for telling people, to buy stocks, for example, even the ones that are on the so-called buy side, they tend to be affiliated with a product producing wing or organization. There may be the private counsel advisory division within a big investment bank where, strictly speaking, they're not brokers, but there's an inherent bias in that institution of let's get people to sign up for more risk. How do they do that? They pay the advisors more for certain products that are more risky that the institution is actually packaging and selling, or they just charge a higher fee on the riskier asset component. So the quote advisor has an economic attraction or incentive to put more capital in harm's way. And you may think that's a benign model if you don't understand, the way this world works, but it's catastrophic for capital because, again, we've been in this extended period where add debt, and everyone boasting about how genius that is. And, it doesn't have to be a disaster. It doesn't have to be, the end of the world when these cycles mean revert, when recessions inevitably come, when bear markets inevitably reset prices. This is all part of the healthy free market mechanism that you're supposed to have. In nature, we have these systems to equalize or reestablish equilibrium. We're supposed to have them. In this case, the longer you suppress and extend, the more violent the aftermath. And again, it is possible to prepare by paying down debt, by building up savings, by controlling how much risk exposure you have to the mean reversion process. But because so few people are actually either paid to tell people that information or have any kind of, moral conviction about trying to actually help individuals navigate these cycles, because so few people, for what many reasons, are actually looking at that survival aspect, the navigation aspect, instead of the throw up the sail and kick back and have a beer. So people are sideswiped, and it does become a life-changing event from which, very often many don't recover because they don't have enough time.
Yeah, well, we look back in history, it's interesting. The Great Depression, first there was the stock crash, but real estate went on for several years after it. Being a boom market, it was still a bubble. And then a few years later, 33, 34, it crashed, maybe 32. I don't remember the exact dates. And then everybody was broke. Well, actually, Florida land real estate crashed in 25. It tends to be about a 10-year bubble cycle, the real estate market. So it crashed in 25. And then the speculative fervor went to Wall Street. And that really extended that. There was already overvaluations in financial assets in 26, but between 26 and 29 is when you had the complete manic phase of that blow off top. Mm-hmm. And yes, then everything sort of crashed at once. And it was for the very same reasons that I think we're going to have a similar challenge this cycle, is because of the lack of cash, liquidity crunch, right? And that's what the Bank of International Settlements is warning about. That's what Moody's is warning about. They've downgraded the Canadian banks again this morning. And it's always, anyone that's lived through a credit crunch knows what it's like. People say, well, that asset is worth X. And everyone says, great, who's got cash to give you that? And the answer is almost no one has cash, because they have been overspending during the expansion, because they have over-indebted themselves and depleted their savings, and because what savings they did have, they didn't keep in, the safest deposits that would maintain its liquidity. They put them in the riskiest deposits and securities, which implode. So it's that fight for who's got cash
that gives the upper hand to the people who have prepared. But it's that holding cash while this process plays out, before you get that buying opportunity, that makes you look like a dud when everyone else is, a wizard.
Yeah.
And that's the hard part. It weighs on people's nerves if they aren't sort of steeled for the fact that to survive these things, you have to actually devise to work in opposite to the masses. And that is very difficult, especially in this age of nonstop social media, digitized assault on your waking conscious, about, people giving you sales pitches essentially of what they want you to do with your cash all the time.
Yeah, well, it takes a lot of guts, as we've talked about before, to go against the trend, to actually think and act. Right? I mean, it's really hard to do that. Not many people can do it.
It's essential. I say, listen, if you can't do it, if you don't want to do it, if you have no methodology or personal discipline to do it, then stay out of this rat race, because it's essential to have your own rule set around when and to what extent you will expose yourself financially to these cycles. And, trying to do it with the masses, it'll feel great near the tops when risk is highest, because everything's going up together and everyone feels like celebratory. And then everyone crashes together, and then it's the great blame game of who's at fault for who's, and essentially everyone's at fault in that, because adults need to be more proactive in planning their financial matters. They do. And they have to have their eyes wide open, because at the end of the day, they're left holding the bag.
Oh, yeah. Yeah, they're left holding the bag, and the financial sector's gotten their rich commissions, and their commissions even go up in a crash because everybody's selling. The volume, when you have this inevitable decline, the volume of everybody trying to sell goes way up. And how does Wall Street make money? Arbitraging and playing that decline.
Yes, but their assets, the bulk of their wealth is held on the security side. So the executives, the employees, the shareholders, their wealth gets wiped in the process. So you're right. It's excellent for revenues because everyone starts selling and there's panic volumes. But for the bulk of where the money comes from, which is the underwriting and selling of securities, which is where the lion's share of all that comes from, and where the compensation or apparent wealth of the shareholders is in the price value of those securities. So those things come down. And that's why the fact that they've made some trading profits doesn't offset the loss on the balance sheet, the loss on everything else.
Yeah, and you wonder if this thing could actually go on for another year or two, which who knows? It's possible. And then with the eventual crash, who knows how bad it's going to be? Can you imagine the world's central banks trying to write checks out of this one like they did during 0809? It was $16 trillion the Federal Reserve sent out to banks all over the world to stop the whole world financial order from collapsing. What's it going to be this time? 160 trillion rather?
Mm-hmm,
I mean, where's it coming from? So eventually got to stop, and then combine that with all the pension plans going down the tubes, all the states in the U.S., all the countries around the world are insolvent here. There's really not many. Russia's the only one that's paid off its debt.
And Russia's got a bunch of other, credit calamities in the making in their households and businesses as well. But the thing is, every 10 years or so, you're going to find, like 10 years from now, the chances that the valuations on securities will be as egregious as they are today is almost nil. The likelihood is that we are going to have dramatically lower prices, and that will reset dividend yields to an attractive level. That will reset investment prospects to an attractive level. So, the question, I guess, I don't think it's going to last a couple more years. But as you say, depending on how much more credit they want to throw at this bubble they've built, it's very difficult to know. But the thing I think is more important is for an individual to say, if you're in your 50s and 60s now, so if it takes another 2, 5, 1, whatever the range of time is, you have to think of it in your own short time horizon and say, will it matter to me 10 years from now that it took 2 or 5 more years to crash and then, there was an opportunity? Will that matter, or will it matter only whether and how I navigated that? So in other words, did I crash with the market? Did I have a credit crunch? Did I have to liquidate assets and panic? Was that, and now I have to go back to work because I didn't plan my cycles well and I was too risk exposed at egregious valuations. Those are the only things that actually matter. Whether you can figure out a way to protect yourself from the down cycle and then be prepared to act when valuations are attractive. 10 years from now, that's the only thing that's going to measure success. And it doesn't matter whether it happens this year or next year or, at what point in the interim.
So a 10-year horizon here, that's what you need to be taking?
Well, I'm saying that most people have to worry about a 10-year horizon because of their age and stage. Again, you're not 20 putting $100 a month from your paycheck into a mutual fund. Okay, that's a certain kind of dollar cost averaging into risk may be appropriate for that age and stage. And because when things drop, you're putting your $100 in and you're getting more units and all that's great. But that's not the world for most people, where they've already accumulated the bulk of their net worth, right, where they're already in their 50s, 60s, later years, God forbid, retired. Many people have retired too early because of the jump in valuations that have happened in the past couple of years. And they're sort of thinking, great, at this rate of growth, I will be, I'll be able to retire and take an income and still grow my money. And right, those plans, I think, have really been set up for great hardship. It's quite horrifying to see how many people have misinterpreted and been given bad advice on the sustainability of current levels, and then have devised their whole retirement plan from this point out based on these unsustainable conditions.
Yeah, best laid plans of mice and men, right?
Yeah, well, there are, you can make good plans, you can take care, you can navigate, you can make intelligent investments. It's just you can't go with the mainstream flow.
Yeah, that's it. Don't go with the flow. And I guess we could sum it up at that. Anyways, if you haven't taken a look at Danielle's site, go over there now, jugglingdynamite.com. It's always thought-provoking, always informative. And at this point in the cycle, always contrarian as well, Danielle. And who would have thunk? But anyways.
Has to be, Carrie, has to be.
Yeah.
I don't really love it, but it's what you have to do.
Hey, you know what? Going with the crowd, if the crowd is going off a cliff, you're going to go off there with them. And hey, be part of the conversation. Email us, kl@kerrylutz.com, Twitter feed @KerryLutz, Facebook page, Financial Survival Network. Danielle, we'll talk to you in a couple of weeks.
Thanks, Gary.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.